Good afternoon, everyone. I'm Stacy Scott, Marketing and Client Relations Coordinator here at Wickham Financial and Insurance Services, and I'll be hosting our webinar today. Thank you so much for joining us for this month's Lunch and Learn. April is Financial Literacy Month, and with that in mind, Graham is going to take us back to the basics of investing. We're going to have an Investing 101, if you will. And for some of you, this will be new information, while for others, it will serve as a refresher, but it's certainly valuable information for all of us. As always, there will be a Q&A session at the end of the discussion. And if you can, just please get your questions in throughout the presentation. Just type them into the Q&A box, and I'll make sure that Graham gets those and can answer your questions for you. And as a reminder, Graham's calendar will come up periodically throughout the discussion. And if you would like to schedule some time to meet with him, please just click on the day and time that work best for you, and we'll make sure to get that appointment scheduled. And now, without further ado, I'm going to turn things over to you, Graham.
Hey, thank you, Stacy, and thank everyone for being on the call. As Stacy said, it's a really important month, Financial Literacy Month. You know, the information that we're going to cover today, the information that we cover in my classes, these are multi-day courses that I teach. This information just simply is not taught in school, but as adults, as consumers, we have to understand investments. We have to understand financial matters to better our financial lives, not just for us today, but also for the ones and things we care about when we're not here. So again, very, very important month. We're going to take a pretty remedial approach. And again, pretty basic approach, defining some terms, laying out some expectations, you know, kind of where do you position on the risk scale in terms of stocks, bonds, cash, etc. But obviously don't have time to go in absolutely every little single detail of types of stocks and bonds and positioning. But we're going to give kind of a refresher course, as Stacy said, a bit of a 101. So something that you can also pass on in the recording to any of the young adults in your home, any minors or whatnot that you want to, you know, pass on some good financial starting information. This could be a good little presentation for that. Well, let's go ahead and jump in. I'm going to go ahead and guide the slides. So Stacy said, Graham Wickham Financial Group. These are the monthly lunch and learns that we do. And from time to time, you know, we might bring in our attorneys talking about wealth management, estate planning matters. We might bring in our assurance teams to be talking about risk management side of wealth management, as well as me, the head of the financial team, talking about investments, investment planning, retirement planning, cash flow analysis, so on and so forth. So again, today, since we don't have all the time to cover all the other stuff, we're just going to get back to the basics, to the root of what is investing, right? So let's think about saving. And I'm going to say versus investing right now. Saving, investing, we want to think about making wise choices of that, all right? But before we decide that, we're going to get into investing. So in investing, you're looking to grow those assets that you're setting aside. Savings, you're actually just looking to set aside things or extra funds that you're not spending, right? So we want to think about creating a rainy day fund. First and foremost, we need that emergency fund in place. As I always say, you know, you want to set somewhere between 3 to 6 months minimally cash aside for your basic fixed expenses. Anything above and beyond that, especially if you're drawing out of your accounts to live off of, if you're retired, or if you're going to be using it for a larger project, let's say a water heater or roof repair, buying a new car, whatever it might be. I think that's something that we always need to be willing to set aside as a rainy day or emergency funds, not tied to the investment markets, either stocks, bonds, so on and so forth. Want to think about right now paying off high interest debt. Right? So again, what we're talking about is before you get into that investment stage, these are the layers that we're going to be talking to. And if you're a client of ours, you already know we do talk to you about this. Create the emergency rainy day funds first. make sure you set aside at least 6 to 12 months of your expenses that you're drawing from your account, so we don't have to worry about negative market performance, stock or bond. Then we want to think about, paying off that high interest debt. Think about it this way. I mean, if you have a credit card out there, and I would be surprised many of us do because rates are now starting to go up. But let's say you got a credit card out there that's got a 15% charge on that. Listen, the average return for the S&P since 1929 is 10, right? So the odds that you're going to beat that performance in the market outside of the last 3 years is going to be tough. And plus, you're putting that money at risk. I'd rather if the interest rate on those credit cards are higher than the market average return, and also, again, it depends a little bit on your personal situation and cash flow, I'd like you to pay those down. Pay them down to the very manageable. It doesn't mean you have to stop or not make investments. We'll get in that in a minute. But I really want to focus you on getting your debt, your what I would call almost bad debt in a way, in check before we really start ramping up our investments. All right. So maybe you want to think about insurance from mitigating risk. We don't want to insure all of what might happen if we're driving down the road and we get in an accident or something happens at our home. We want to mitigate through some of that risk by transferring some of that risk over to insurance companies like your home, your auto, life, health insurance, so on and so forth. So those are just steps that we want to think about. And then you have an option to invest. You're employed, your employer has a retirement plan at work. Maybe it's a 403B, 401k, 457, simple plans, or heck, you just go into an IRA and Roth. Great first avenues to start, because now we're thinking about being tax conscious, either tax deferred, meaning we don't pay tax until we draw it out down the road, or in a Roth situation, Roth 401k, Roth IRA, we don't get a deduction on any money we put in, but if we hold it for a certain period of time or over a certain age, it all comes out tax free. So we just want to be mindful of making those first steps first, lining up where we're at, reserves, paying off high interest debts, making sure that we're mitigating risk where appropriate in those avenues, and then look at your employer plan first, especially if they have a match. If they don't have a match a part of that plan, let's talk about some other options, right? And I think that makes sense. So now let's get into investing. All right, you've saved your money, you've earned money, you've saved money, so you set your reserves, you've done other things we talked about previously. Now it's time. What do we need to do to grow this money, right? And why are we doing it? And I think before you get into investing at all, if you've been to my classes that I teach, we spend a whole section. We've got 8 sections we cover over 2 days. The first section is basically taking a step back and thinking about what your bigger picture plan is. What's your vision of your retirement? What are the goals you're trying to accomplish, by investing? Is it to buy a home down the road? Is it, to pay for college? Is it retirement? Is it just, hey, I want to beat inflation, the cost of living. So what is that goal? Think about your time horizon. You might have multiple time horizons within your investment path, your financial path here. So you might say that, hey, listen, in 5 years, I know I got to pay for college. First time horizon for that lump of money. Hey, in 10 years, I want to buy my first house, or I want to pay it off. Okay, that's that next time horizon. And then you have retirement. When do I need to be drawing out to supplement how I want to live in that next stage of my life? However you define that. So that's I think about multiple time horizons within your lifespan, which is obviously the ultimate time horizon, right? I mean, the odds are we're going to live another third of our life, 25, 30 odd years above 65 years old. I mean, we're planning now to 95 years old. So you got to think about, how can I have my money last over an extended period of time? And also be mindful. Inflation plays a huge role. I mean, I know we're all experiencing that today, and we're in a high inflation environment, 8.5%. So any return on your investments, your savings account that is below the inflation rate, your real rate of return is negative. Then if you got to pay tax on that, it just compounds, right? Because you don't get to write off inflation as a loss, unfortunately. So we got to think about being mindful of money, not having lazy money. What's our time horizons? Be real with that. Understand your risk tolerance. I think really important. Remember, when you're investing after earning, after savings, now you're thinking about how can I grow and take some risk to really grow this money for down the road. You got to think about where are you comfortable with risk. Everything has risk. And we define that in CLIS. Everything does. Cash has risk, right? You have inflation risk, you have interest rate risk, you have market risk, you have business risk, you have currency risk. Everything has inflation, has risk. So we just want to be mindful of that and understand that when we start investing, we want to make solid business decisions, not emotional decisions, right? We want to understand what we're investing in, why we're investing in it, how long are we planning on that investment being in there, and what is the goal and objective, the end, if you might, what is that end in mind for these assets that we're setting aside in those investments. So let's get into the real basics here. And again, it's just basics. We don't have a lot of time to cover all the details, but let's get into some basics. You know, here we got a little chart on the left side. We're talking about potential return. And then we got the bottom line of risk. So if you look at it, stocks take the highest risk, right? Individual stock risk. These are companies that you're buying ownership in those companies. Hopefully you're participating in all the positive qualities of their earnings. You know, you get the opportunity for the price appreciation, but unfortunately, you know, if it's a company problem or a market situation, hence the two risks, company and market risk, you know, that stock could come down and you could lose money. Right? But time tends to create or increase the odds in a good quality investment that it at least increases the odds that you could have positive performance. All right. So down that line, we would have bonds and we'll have cash that will kind of wrap up the financial education with, and then we'll cover some market stats to end the call. But let's talk about stocks. So since 1929, let's just throw the S&P index. That's a Standard & Poor's 500 stocks based in the United States across all sectors, has averaged about 10%, right? Over the last 3 years, to put this in perspective, the market, the S&P index, has averaged roughly around 25%. Over the last 10 years, the market has averaged roughly around 15%. So we've had extremely strong performance over the last 10 years compared to obviously a long-term average of the market. And the long-term average of the market is pretty strong, all right? So again, when you're thinking about investments, now we're thinking about stocks, we're thinking about owning companies, so we're creating equity, right? You know, we're owning these because we want to grow our money. Maybe we want to beat inflation. Classic stocks have been an inflation hedge. Why are stocks an inflation hedge? Think about it this way. When you're owning a company, and generally company stock prices follow earnings, all things being equal, right? Earnings good, stock prices go up. Ideally, that's how it works, generally how it works. So if a company is selling its products and services and the consumers are buying it, they're having more revenue, right? More profit. And if they got more profit and revenues, their earnings are going up. Their earnings are going up, stocks go up. But in the inverse, if demand comes down for that service or product, that's less revenue, hence possibly the stock should be coming down. Right? So that's why we think about inflation. What is inflation? It is strong demand, right? And we're in a strong demand environment, even though a little more challenging market right now. So we got high inflation, strong consumer demand, corporate demand. What's happening? Inflation is high. Earnings have been reasonably good so far in this earnings season, but over the last couple of years, companies been strong. So we've seen strong stock prices. All right, so I hope y'all follow along with that. You know, stocks you can buy and sell relatively liquid, 9:30 to 4 o'clock or when the exchanges are open. Again, it can provide that capital appreciation. Maybe it pays a dividend. So you can get paid two ways, potentially capital appreciation and maybe spins off some income. Again, poor performance in the market or poor performance in the company, hence the value comes down. Right? But you do have a greater risk to principal. That's why we want time on your side with good quality companies, good quality management team, good quality products and services they offer. I'm not a big believer in buying things with a hope and a prayer. I want to have a plan behind them, and I want to put everything we can in front of us to succeed, and that doesn't discount owning stocks with good management, good products. All right, but again, they're subject to consumer demand in terms of profits, revenues, and just good old-fashioned market volatility. So let's think about the different sizes of stocks. They're going to matter, right? So we talk about micro caps, small caps, mid caps, large caps. I could throw in here mega caps. You got all these different terms, but they might perform differently over time. If you look at the latter, micro caps and small caps, maybe all the way up to mid caps, the smaller, more nimble, more risky type investments like micro and small caps have outperformed the performance of mid caps and large caps. But in the short run, and certainly during certain economic times, hence a bit what we're in right now, high inflation, interest rates going up, can really negatively affect micro caps and small caps, and even mid caps more than large caps. Why would that be the case? Well, think about it. Small and micro caps may be a little less proven. Maybe there's profits and revenues that are really down the road, but they got a neat product or service that they're offering today. So when interest rates go up, their borrowing costs will go up to leverage their business, to grow their business, over time. So that can affect the balance sheets. Again, earnings come down, stock prices can come down. So if we go up that ladder, back up to large caps, established companies might not have as high a growth, right? Especially in the long-term charts, but they might provide a certain level of stability, especially, if they pay a dividend out there. So people are paid to hold while they're waiting for those stocks to outperform. So a little bit lower volatility, maybe a little bit lower growth. You might expect a little more income from those areas. All right, so micro caps all the way up to large caps. So when we're thinking about diversifying within stocks, you would want to think about diversifying between all these categories. If we look at now bonds, all right, so bonds and stocks, that constant struggle. So we look at the chart again, we have stocks take the highest risk, bonds are in the middle, and then cash will end with, don't spend a lot of time on that, but we'll end with cash. So let's think about bonds. Bonds since 1929, government bonds on average, about a 5 or 6% average annual return. So quite a bit less than stock. But if you think about it, at least on that scale, they provide a good bit less volatility, right? So if you're thinking about owning or being basically an IOU, buying some fixed income, you want to buy it with the correct expectations, right? You might not buy bonds for the long term to beat the stock market performance, say the S&P, at least based on history, but you might buy the bonds maybe for income, right? You might buy them for a level of stability. Maybe you don't want all the risk of owning stocks in your portfolio, right? You want to stabilize it, lower the risk a little bit, maybe provide a little bit higher steady income stream. And let's think about it this way. If you're in a high income bracket and you want some tax-free income, well, then you can look at municipal bonds, all right? Municipal bonds are pretty unique. You buy municipal bonds or debt of local municipalities, so on and so forth. You buy them in the state you live in. They're federally and state tax exempt, but you can buy municipal bonds from all around the United States. So certain times in the economy, a bit of what we're going through right now, certain sides of the market are going to look more attractive. Stability, you might find a bit more stability in certain bonds, but you might have better performance in stocks. You might have more volatility in those micro caps and small caps that we talked about. But again, it's all about positioning inside a portfolio and making adjustments, and I'll allude to that in a minute. The good thing about bonds are if you buy individual bonds, to stay on this subject for just a little bit longer, if you buy bonds individually, all right, you don't get all of this in owning them in a bucket like an ETF or a mutual fund or a unit investment trust. But if you buy individual bonds on their individual basis, you get the maturity, right? So you buy a bond today, let's say it matures in 10 years. In 10 years, if it doesn't default, you're going to get all your money back and you've made interest all along the way, right? Stocks don't give you that guarantee, right? History has proven, not across every stock, but history has proven that it does pay off in the long run, owning stocks over bonds, at least in certain areas. But they don't have that maturity factor that bonds do. All right, so they can provide a level of safety and preservation that stocks don't. But bonds are going to be pretty challenged, as we know they're not keeping up with inflation. So let's think about this. You're owning, let's say, a taxable bond, and it's making 2%, or say 2.5%. The aggregate bond portfolio, the aggregate bond market is. Let's say that's the average yield on that. Well, inflation right now is 8.5%. So basically, you're still losing 6%. So again, you have to own things in proportion, be willing to make some adjustments and change a part of a plan and strategy. And I'll get into that in a minute here. But think about it this way. Why are bonds down? I mean, we're seeing aggregate bond indexes down 8%, more aggressive bonds down a lot more than that. Why? Because when interest rates go up, they negatively affect older bonds. Why? Well, think about what I said just a minute ago. When interest rates go up, and we've had really, really low interest rates for the last 12 odd years, right? So as interest rates go up, newer bonds that are being issued, right, are going to be issued with higher interest rates. So individuals owning older bonds are going to be paid less than newer bonds, so they might sell their older bonds to buy the newer, higher coupon yielding new bonds. All right, so that's a general concept of why. Right, but again, all this ends. Inflation, interest rate tightening will end. Inflation will be tamed sometime down the road, and bonds will probably come a bit more in favor, just like growth will come back in favor a little bit more down the road. But right now, it is a bit more challenging for the bondholders looking for that safety, that preservation, because we are getting a lot of volatility in that side of the market. All right. So let's jump into what type of bonds. Well, when you're thinking about the classes of bonds, you think about maturity. When do they mature, right? Long-term bonds are 10 years plus, intermediate are 1 to 10, short-term 1 year. So if you're worried about interest rates going up, inflation, maybe you want to stagger the maturity out on these bonds. So you got bonds coming due to take advantage of these rates going up, right? To protect your portfolio against inflation risk or interest rate risk. You can own bonds of companies like Microsoft or Amazon or any company that issues debt to municipalities that I mentioned. The government bonds are generally the safest. Why? Because they can tax everyone to pay back those bonds, right? So they might yield the lowest, but they tend to be the safest because the U.S. has never defaulted on their debt. And of course, you can own international corporate and government debt as well. Think about the quality. So you're going to get paid less on high quality bonds, maybe high investment grade bonds, but the more risk you take on junk, you're going to get paid more. So you want to weigh that out in terms of your risk reward, your time horizon. And then tax status. You need tax exempt municipal bonds. Taxes aren't an issue. Maybe taxable bonds can do just fine because your rate is lower. But think about this. In your taxable accounts, municipal bonds could play a role for your bond type exposure because it's tax-free. Why be taxed in your taxable accounts any more than you need to if you're in the middle of your peak earning years? Maybe those taxable bonds might be better positioned, maybe over to your taxable accounts, right? So let's end here with cash. So we covered stocks, we covered bonds, and cash. Now keep in mind, we have it here. I don't fully agree that cash is an investment, but in light of current situation, doesn't mean you don't have cash, right? You just don't have the majority of your assets in cash, right? Because one, inflation's 8.5%. Let's say you're getting 0.25 or heck, 0.5% on your cash position and savings or your checking account. Well, you're still losing 8%. If you're making 5% in the money market, a savings account. So we just want to be mindful that we don't keep too much. So this cash position, I would say it's money that you want to be returned to you, not necessarily money that you're getting big returns on. That's your emergency funds. That's your rainy day funds. That's I got to put a new roof on the house funds. That's I got to replace the water heater, buy a car. And that's something that I would say, within 6 months to 1 year, or it's just covering maybe 3 to 6 months of your fixed expenses just for safety's sake. All right. But keep in mind, as interest rates move up here, so will the money market accounts, so will the saving accounts yields. They're going to be moving up to do. Just keep in mind, they don't move up that fast, that quick. And right now, it looks like inflation is pretty stubborn. So let's look here at a historical rate of returns, from 28 to 41 and 42 to 68, 2009 to 20. Let's pick the 2009 to 20. We just threw that in. We were struggling a little bit getting 21 stats just to fit it all in here correctly on how they were measuring on this chart. But if you can look at it, I mean, obviously your performance is going to come with stocks, but as you notice, they have consistently, they got more volatility. And if you can stand the volatility based on your time horizon, which I would generally encourage you to hopefully be able to, you're just going to outperform bonds. You're going to really outperform cash, because really, if we want to believe it or not, inflation is there. It's always going to be with us. It might not be 8.5%, right? But look, over the last 10, 15 years, inflation has only been around 1.9%. So yeah, we expect inflation to drop back down, but who says it's got to come back down to 1.9%? What if inflation only comes down to 3 or 4%? That's still really high compared to at least the averages we've experienced over the last 15 years. So you have to take risks to get the reward. I know it's not always comfortable, but stocks over bonds, you still need cash position, but how you weight depends on your time horizon, your risk tolerance, your goals. What's the end in mind that you have for all the savings that you've set aside? So last but not least, I'll kind of wrap it up here before I get into some stats. Think about, owning baskets. Like, you go out and buy individual stocks, you can buy individual bonds, but you can go out and diversify your risk with owning mutual funds or exchange traded funds or even ETFs. Owning baskets. So you mitigate, diversify your risk by owning baskets, right? But keep in mind, it could limit some upside because you're not owning that individual stock and getting all the upside performance, but you're also not getting all the downside. All right. Also, keep in mind that different products have different expenses and different tax efficiencies. Mutual funds are a little bit less tax efficient because, someone moving things around more, where ETFs might be a little more cost efficient, a little more tax efficient, because they tend to be what's called passive strategies, less active. All right. So ways to mitigate, diversify. So to wrap this up, when you're thinking about investing in stocks and bonds and cash and all the ancillary byproducts, you want to think about building your house, right? So think about when a house is built. They don't start at the roof or the chimney. They're starting at the foundation. So think about building a solid foundation, right, of your more secure, diversified assets, funds, ETFs, indexes, more conservative products, and then build up into that house, up into the roof, the attic, the top of the chimney with your more aggressive, maybe a little bit lower exposure areas like high yield debt, bonds. It might be small caps or micro caps, international compared to domestic, so on and so forth. All right. So let's go ahead and jump into some stats. And I know this is probably why everyone's really been on the call. So let's look at the kind of what's going on out there. There's a lot of rumors about recessions, so I did want to kind of leave with some character, at least in light of Financial Literacy Month. Let's understand that recessions happen. They're a part of our investment lives. It's going to be a part of your life. If you want to experience it or not, you actually are. There's been 33 recessions since 1854, 10 recessions since 1950, and 1 depression since 45 outside of 2008. And a recession is not a depression. I want to really make that point. A recession is not a depression. And not every recession leads to a bear market, but not every bear market leads to a recession. So we do want to be mindful of that. Because on average, the average recession, the markets are only down 5.3%. But if we look at stock market corrections happen all the time. We've had 26 market corrections, and we're in the middle of a market correction, and certain sides of the market are what's called a bear market, that's down 20% or more. We've had 26 since World War II. These things happen. The average decline is 13.7%. The recoveries take on average about 4 months. Now, look at this. We've had 12 bear markets, 20% or more since World War II. But the decline has been about 32.5% on average. So in a bear market, could we expect the indices to go down more from where they're at? Yeah, but history has proven, there's no guarantee it's going to repeat itself the same, right? But history has proven that a little bit of time, we can get past this, right? Most recent was in 2007 and 9 on that bear market, and I would really put that in the depression camp, the market was down 57%. Keep in mind, it's different. This time is different. We had a correction or right at a bear in 2018. Bear markets last on average 14.5 months. All right, so just over a year, and sometimes they've taken a couple years to resolve themselves. Here's a little chart on bear markets and market corrections. If anyone wants this, just let us know. Again, you can always go back and view this in the recording, but we can send the slides and these stats out to you. All right. Last but not least, let's see kind of where we're at right now. The Dow's off about 10% year to date. The S&P is off about 13%. NASDAQ's off 23%. And again, I think these are from highs. The Russell 2000 small caps off 23%, and the Dow Transport's down. So the latter two are in a solid bear market. One is approaching it, Dow Transports. We'll see if the S&P approach a 20% decline. Again, I'm not going to say and rule it out. It could happen. But I'm not going to say that we have to have a bear market for this market to turn around and start trending up. You don't have to. So just keep that in mind if you're looking at different market events, so on and so forth. Stacey, you want to open this up to a Q&A?
Absolutely. We do have a few questions that have come in. The first of which is, should I have only a Roth and not both the Roth and the IRA accounts?
Okay, so should you, let me see if I understand that question right. Should you move all your money into a Roth instead of having a Roth and an IRA?
I think that's
about correct?
I think so.
I don't know if it has to be one or the other. I love Roth accounts because, yeah, you don't get a deduction today, right, on the money that you put in, like an IRA or a Roth, right? But listen, if you meet the qualifications, 5 years and you're over 59 and a half, it all comes out tax-free. And you got to think, if you're 20, 30, 40 years old, heck, even 50, I'm 50, putting in a Roth could be a massive advantage down the road. So I don't know if you have to just be all into a Roth or all out. Maybe you do a little bit of a Roth, you do an IRA, and maybe have a brokerage account as well. Since we don't know where taxes are going to be, at least you're covering all three buckets. Tax now, tax later, never taxed.
That makes sense.
Yeah.
Okay. The next question is, for people who are just beginning to think about investing, what is a good starting point for them?
Well, look to your employer first, right? Make sure you got your emergency bucket taken care of, those reserves, everything we talked about, high interest credit card debt paid out. Now you're ready to invest. Look at where you can get tax deferral. You don't pay tax on it, right? Or you pay tax later. So look at your employer plan. If you're employed and they do a match, at least max to the match at your employer. And then look at owning a broad-based basket approach. Maybe it's just owning the S&P index, right? Through an ETF or the index in general. But start out owning baskets of maybe a broad-based index, low-cost product, and then build up from there.
Okay. Well, talking about stocks, when is the right time to buy or sell a stock?
That's a great question, right? The way I generally look at it is that when it doesn't meet your goal and objective, right? When the fundamental changes, right? So when fundamentals change, that's balance sheet that's balance sheet stuff. If management changes, fundamentals change, these would all be things that I would say, okay, is this still going to meet my goal and objective that I want to own? Just because the stock's down doesn't mean you don't own it or you don't hold it. Just because the stock's done well doesn't mean you buy it, right? And I think a bit of this market is seeing that right now. A lot of people are chasing these high growth, they got great products, great service, but no real earnings. Listen, that side of the market's down 50, 70%, right? So I think it depends.
Okay. Well, we do have one more that I want to get in with you. How aggressive do you think the Federal Reserve is going to be to tamp down inflation?
Well, they hinted the last week to 2 weeks that they're going to do whatever it takes. They, definitely hinted at, don't be surprised at 50 basis points up to, and then the rumor in the market is maybe 75 to 1. I think the Fed's going to do what they need to do to get inflation in check. we just have to see is inflation plateauing right now. There's some, conversation that it might be plateauing a bit, maybe peaking out, and it might roll over, maybe plateau and start coming down as supply chains open up, the economies open up, so on and so forth. But as long as we have strong wage pressures, as long as we have commodity prices up, and that's probably not going to change tremendously, I think inflation is going to be stubbornly high, which means the Fed has to keep their eye on the ball and be as aggressive as they can. So again, that's a bit up in the air, but right now they've hinted they're going to do whatever it takes.
Okay. All right. Well, thank you so much, Graham. And I think that was great information for investors of all ages and all experience levels. It's always good to get back to the basics and remember why you do what you do. And as you all know, we post our most current information on our social media pages and our website. So viewers, if you could please take a look at those as well as our website to stay on top of all the information that we're getting out to you. Thank you so much for joining us today, and we will be looking forward to seeing you again next month at our monthly Lunch and Learn. Thank you.
Thank you. Have a great day.